Hey everybody, Preston Brent here with our Trader User Group, a free weekly roundup for the trading week ending February 17th, 2017. What I've got on the screen here is what I always start off with on my weekly updates is the daily chart, in this case, of the S&P 500 E-mini futures. Got a lot marked on my screen here, but what I'd like to do is just take a couple of things off the screen and just kind of show you where we can expect some resistance levels at these points up here. So if I just come over here and take everything off the screen, of course you can see the big move that we've had. I mean, off the presidential elections right here, it's just been straight up. And this is, further proof, if you're not already aware, that the markets move on expectation. All of this has not come through yet with the less regulation, tax cuts and so forth with the U.S. markets. But again, the markets are expecting this with the Trump administration. And should these things come through, then we've made a good part of the move already, I believe. Tax cuts are probably the most wanted outstanding regulation that or policy they'd like to see from the Trump administration. First, of course, regulation, but taxes will probably goose the corporate earnings by another 5 to 10%. Right now, the markets are forecasting 2017 earnings growth at about 10.5% on average. 2018, about 11.7. And that's without any of these tax consequences. The tax consequences can, almost double that growth. So that's why we're seeing a big move like this so far. Now, we're already, guys, into the second longest bull market in the history of the U.S. markets. The best, you may wonder, is 1990 going up to the dot-com bubble in the year 2000. So we've already had, this is, we're literally running on now 90 plus days of not seeing a pullback of more than 1%, a drawdown of 1% in a day. And we're just constantly breaking records and making new all-time highs. Now, as you can see with this move here, then the question becomes, because we're trading up in dry powder, we've actually been trading in dry powder from this level here for quite some time. And I put a Fibonacci extension off key pivot highs and pivot lows. And I'll show you which pivot high and pivot low I use to generate these key extension levels here in dry powder. And you can see, again, this is a daily chart, how we've hung up at each of these levels, each one of these levels, from this level to this level to this level, and now we're at this level here, tend to slow us down for anywhere from, a couple of weeks here to almost a month right here, maybe 2 months, or a good solid 6 or 7 weeks here to about 2.5 weeks there, and now we're just a few days into this one right here. So each step of the way, we've been moving higher and higher. So generally, when we're making new all-time highs and you're trying to determine, well, hell, where is the resistance point? It's easier when you're trading levels that we traded before, because you got key price level support and resistance zones that you can use. But once you get into blue sky territory, or into what I call dry powder, meaning we've never been there before, you need some of these extensions. So if I put it back on a weekly chart here, it'll show up a little bit better here. You can see on these weekly extensions, and again, there's some subjectivity in selecting pivot highs and pivot lows, but I always like to use a weekly chart to do it. I selected this area right here because this was one of the longest records on, or one of the longest levels on record that we had before we came up and actually cleared it. Typically, when the S&P makes a new all-time high, they can clear it within a year. You generally see them clear that level again within about a year or so. When it takes longer than that, then there are some issues. So this is clearly a key pivot point here, a pivot high, right? So I marked this level right there as a key pivot high. And we actually hit it in April of 2015. And then you could see our first clearance was in July of 2016. So about 15 months before we actually took it out. But then because it's such a key level, we came up and we did numerous retests, and then we came back below leading up to the Trump election, and then away we went like that once Trump was elected. So you can see that big bump here is strictly due to what Donald Trump has said he's going to do for the U.S. economy. All of that right here. And I would surmise to say that had the Democrats won, it would have been more of the same, because that's what we've had for 8 years, and not trying to take a political stance on it. I don't think we'd definitely be up at these levels right here. So that was the key pivot high. And so I chose that level, the key pivot high, and then the key pivot low was made in February of 2016. And you can see here that we hit it a couple of times, and then the second test right here, and then away we go. And you could see that every time the markets, and if I were to just extend this way off the screen here, it held us up, you know, going all the way back to 2014. So I think we can agree that these levels are key pivot highs and pivot lows. Once I did that, I ran a Fibonacci extension, because, you know, once we got up in this level, it was really hard because we'd never traded there before. Where's the dry powder? Where are the potential resistance points? So running it, you could see this was the first, second, third, and fourth level. Now, most systems default the Fibonacci's. If they don't, these are the levels that I use, which history has shown are very, very good levels to use. The 236, the 3.8, the 1.5, and the 6.1. And then, of course, you know, I can move it down just a little bit more and show you that now we've got a level 2.0, which would be a 200% rise, which very rarely is hit that this quickly. I mean, guys, that's a 200% move off a pivot high and a pivot low. Generally, the favored stop out point is right in that area right there off a solid run. A 3.8 extension or a 6.17 extension off that pivot high and that pivot low. So I expect even more resistance at this level. You can see here on this weekly chart, we really just ran up in 1 week, but I suspect it's going to take a lot. If we clear it, we're going to come back down into it again. Looking at divergences, there is absolutely zero divergence in this. We call it a bearish divergence. There is absolutely zero bearish divergence on this weekly chart. Keep in mind the time frame that I'm using here, which would suggest that any downward move is going to be met by happy buyers picking it up. Okay, now what can set us down lower? Well, what would set us down lower? And keep in mind, from the Trump lows, right here, what could set us lower, maybe 50% of this move higher, would strictly be if he starts to have trouble getting his policies through, primarily his tax policy. And I could run a Fibonacci retracement on this, right? And you can see on this retracement, if I overlay it on the extensions, this retracement, the most probable stop-off point would be anywhere from right here to right there, in that zone right there. And right in the center of that zone is that level right there. So there's an area of congruency sitting around 2214, all the way down to about 2200 would be a very common stop-off point if the market suggests that Trump's going to have trouble with his tax policy. And you can also see on this weekly chart here, I have volume over price. And now you can see right in that area there is another very strong area of support where there was more buying here versus selling. And that would be the final area of support right around the 2150 area. Okay, right at that area there on this extension to the downside. So we've got a couple of really good support areas. Now, again, the markets are forward forecasting mechanisms. So a lot of this run here from the Donald Trump low or the election night low, November 8th, to where we are right now is based on the expectations of less regulation, less taxes, you know, a lot of spending for the military, a lot of infrastructure spending, and that tends to be very accretive for the growth opportunities of U.S.-based corporations, which is clearly what we've seen. And we've got this very wide range here. This first level here, I'd call it an S1 level, and this an S2 level of support looking longer term. I do expect some softening in this upside movement here, but again, because there is zero bed on here, zero bearish divergence, then I would suspect that any movement down in this area, the further down we go, the more buyers are only going to be happy to step in. If they step aside, that's because there's issues with Trump getting his policies through Congress and the Senate. I don't anticipate any problems. There could be some delays in this, but again, this is just strictly speaking, not on the merits of what Trump's doing, but on the basis of how price action is going to interpret that. Okay, now if I take that back off the screen again, the other thing I wanted to remind you is off of these, again, this is a weekly chart. So you can see here going back even further to February of 2016, this just huge move up here. As the markets have been moving, and let me just take it back even further to give you this bull run that we've been on here really since March of 2009. And again, this is a weekly chart here. And I've got everything off the screen so that you can see it very clearly. I'm just shrinking the chart down here. You can see right here clearly this marked the end of that bear market that we were in starting in 07 through 08 into 09. And then we've just been, you know, balls to the wall, flat up, you know, since then. I don't have any trend lines on my chart, but I just manually drew that in there. You can see the chart right here. Again, a pullback here would give up most of the gains since the Trump election, that upsloping trend line, but we would still be in this bull market, right? A bear market is defined as a 20% drawdown, and that would take us, you know, much lower than this level right here of 2166, roughly, if I were to extend the trend line here. So this is kind of where we're sitting right now, and you can see there is no bearish divergence right here at all. So that does suggest any pullback is going to be bought. But we've been in this long run here, one of the second longest bull run in the history of the markets, going back to 09. All right, and we're already in 2017, guys. So you're looking at 8 years in this thing, and a lot of it's been spurred by the FOMC at 0% interest rates. Our balance sheets have grown by almost $10 trillion. So when you put $10 trillion into our economy at 0% interest rates, the markets have nowhere to go but up. Now, there's going to be ramifications for all this going forward. You can pretty much assure of that. You just don't know when and how and what form it's going to take. But keep in mind with this big long run here, margin debt, right? As the markets move higher, believe it or not, margin that brokers and firms lend out for you to buy on margin actually go up. Doesn't go down on an up move in a market. And the higher the markets go, the higher the margin debt goes. We've had about 193% growth in margin debt. Right now, it's almost at $1.5 trillion in margin used to purchase. Now, that's a good thing and a bad thing. It's a good thing because it helps up moves begat more up moves because people are using borrowed money and margin to move it higher. But the downside of that is if the markets really catch tail and start moving lower, there's going to be a lot of margin calls. And that tends to beget an even further, more aggressive downward move as more people are being forced to margin call and they have to liquidate their equities to be able to do that. So it's going to make for a very interesting 3-year run between 2017 and 2020. Okay, it's going to make for a very interesting run. We're going to profit very nicely in our group when we, and I had founded our group in 08. Right in that area there is when I founded our group. We made great money to the downside there, and then we started shifting right in this area here, and we've done very well since. But I think we're going to have another opportunity to really accelerate some earnings. Not should, but when it happens. But you can see this big up move on this weekly chart. So getting back to this, if I put all of my indicators back on the screen again, and let me just zoom in, you can see here that we made all-time highs just a few days ago on the E-mini S&P futures, 2351. You can see it right here. So we're at and just kissing right up to our all-time highs on the E-minis. If we look at the NASDAQ, which the NASDAQ 100 futures, which is the best, you can see that we actually finished on all-time highs. We're continually making all-time highs. And the amazing thing in this is look at the MACD pattern here. I mean, it's just like this. There is, not only is there not bearish divergence, there is zero bearish divergence. There's new money coming in with each new run that we make higher off of the Donald Trump electoral win or when he won. It's just been, I mean, it is just the vector of this move is straight up. Folks, that can't last. We are going to have a pullback in NASDAQ, but it's going to be a buying opportunity because there's just a lot of money in there and people are, you know, we're getting, as this runs higher, more people are jumping in trying to catch this thing. But, you know, some people are going to suffer as we pull back. But I don't see a big pullback coming. I think any pullback right now in NASDAQ is going to be bought. If I was doing a pair trade, I would short NASDAQ. And if we look at the Russell was the underperformer. The last time the Russell had a high was all-time high was on December 12th, 2016. And then it just made new all-time highs just about 5 days ago. It took 5 days to come back up and take out prior all-time highs. NASDAQ, E-minis, and Dow have been making all-time highs almost every week, or in NASDAQ's case, almost every day, or the Dow. But it just took a few days ago for the Russell to come back and catch back up again. So the Russell is also kissing at all-time highs. If we look at the Dow and look at the Dow futures here, the Dow futures, again, we're kissing at all-time highs here on the Dow futures as well, right up here at 20,632. But you can see here a little bit more of a bearish divergence in the Dow. And then, of course, if we look at the let's see, we talked about the Russell futures, the Dow. So you can see here that the markets are just blasting higher. I mean, just really blasting higher. I think a little bit of a pullback's in order because we're hitting some of these Fibonacci extensions up in these dry powder areas. Now, the other thing that's really interesting is if we look at the volatility, and I got our members long volatility a few days ago. But you can see here, all right, suggested long volatility trades. We're near our 2017 lows, which is at 1030. Statistics show that volatility that is low, meaning underneath 12, can stay low for a long period of time. And then it's met by equal, huge, fast, sharp up moves, which do not last very long, right? And you can see this pattern like this. And you know, if I were to draw these lines, and it won't be exact, but I can just draw this trend line down like that, or maybe like that. That would be the trend line, right? You can see this trend line here. So a spike up into this level, around an 18 level, to me makes sense, or maybe up into this 20 area would make sense. But it's almost impossible to call out when that spike's going to happen. It's usually an existential event through something that comes out of China, some unexpected market noise. There's plenty of geopolitical going on in Europe now, or in China, which we'll talk about this Sunday in our Sunday night session for our weekly market watch. But it's going to be, right now, vol is very low. So higher volatility is like catnip to an options trader. Lower volatility in this green zone here, you've got to change your strategies and how you trade options. You know, and that's what we're doing. We've got a great strategy that we've been running now. We've been successful about 85% of the time, and we're making good money on it. And we're probably going to stick with it throughout 2017. It's a great strategy. And again, if you're interested, I highly encourage you to come in and join up with either our secret trader, which you can follow the trades that we're doing, or in our trader user group plus secret traders. So these are just some things you should take advantage of. But that's volatility. Very low right now, which means we're subject to some up moves. If we look at the bond market, you know, the bond market is now in a little bit of a stalemate. I had projected bonds down around 144 after we hit these highs here, right around the 153 area. But we're now, let me just move this out a little bit so that you can see it better. We're now in a little bit of a stalemate here. And we're going to breach. We're going to breach one of these. If I were to just draw it in here, you can see this area right here. We moved below here, but it was really on a bullish divergence kind of move, and that suggested that you should go long bonds back in early December of last year, which would have been contrary to most thinking opinion, but the chart said go long. And that was kind of, you know, the way to play that. Now you can see this 50 EMA right here, which held us up in early January. We were only, and again, this is a daily chart, we were only one day above, and then we quickly moved back below the 50 EMA. If we can regain the 50 EMA and hold it, then I suggest we're going to move higher, which is going to suggest a little bit more of a pullback in the equity markets. I do not believe we're going to hit the 50 or the 200 EMA, which is sitting at about 158. I just don't see that happening. But I do see us staying in this quagmire for a little bit, and then we're going to either punch through there or punch through there. So we're looking at some trades here that can take advantage of this in the bond market. All right, so that's a little bit about where we're sitting here with bonds. And then, of course, if we look at currencies, we look at the U.S. dollar, it was up, you know, about 0.4%. You can see the dollar move. We broke out of this regression channel. My forecast for the dollar was right back up into this area here around the 105 area. The dollar has got to clear and get some altitude, escape velocity above the 50 EMA, but that would be my general trend for the US dollar. But then I think the dollar is going to give it up and spend the latter half of 2017 going in the down direction. And then by the same token, I believe the euro is going to spend the latter half of 2017 in the up direction. You can see this move right here in the euro. Again, the euro represents about 60% of the index value of the US dollar, so they almost, the patterns, they almost look like put a mirror up to the US dollar, and this is what you get with the euro. Very similar. So here you've got this tight correlated regression channel to the upside. We broke it to the downside, and we could see a little bit of further move down here, which would be a further move up in the dollar. That would be the forecast, and then boom, away we go with the euro to the upside, dollar to the downside. That's kind of how I'm looking at it right now. And then, of course, the British pound. It fell a pretty good little bit on Friday with some of the slack in retail sales across Great Britain. The big issue with the pound right now is in this Brexit, will they be able to hold through their growth in the Brexit? It's going to take a couple of years to extricate themselves from the European Union, but Theresa May is going to formally file for that Article 50, which means they can then start negotiations with individual countries. So we're going to see the pound kind of stay in this area right here as it's done, right? And then we're going to break either up here or down here. And to be honest with you, a lot of it is going to determine how they come through with the Brexit. The charts would suggest a break to the downside near term. Okay, but whichever way we break, if we break to the downside and get down in this area here, some people have forecasted $1.10. I hope we do. Because if we do, I'm going to be a buyer of the pound because I think that's just a little bit overdone. I think this move here is a little bit overdone, but right now it's just a chop. And I'm going to wait and see how it plays itself out. The yen has just been going like crazy. If we look at the yen, you can see this move here. The yen moves almost like the U.S. bond market moves. Think of the yen as kind of like the currency, a safe haven currency. When the yen moves up, the Nikkei moves down. The Nikkei index moves down, and you're seeing here the yen kind of moving up like this, almost like the bond chart right now. They look very, very similar. So I'm expecting a little bit of a higher movement in the yen with a pullback in the equity markets or a softening in equities. Gold, yeah, we were down a little bit on Friday, but you can see gold is still, we cleared this 200 EMA, which is very important for me, right? We sat there for a while. Once we cleared it, we had the requisite retest, and now we're back up here. If we can clear that hurdle right there, we're going to go to the upper part of this channel. If we break it, you can see the 50 EMA, that the vector almost simulates the same upward vector of the channel, and there is almost zero, just a slight bit of bearish divergence, which would suggest a pullback to the 200 EMA, catch some wind, and then away we go. So I'm just following this, but right now I'm still bullish. Gold, I said right at the beginning of the year, gold's going to finish the year higher than where it started. I think that was a relatively easy bet to make, and we're following up with trades to that effect. Same thing with GDX, but you'll see GDX is much higher. You can see with GDX, it tends to lead gold. You can see the 5200 cross in GDX. You can see we're in a little bit of a pullback, but I'm not too concerned about it. There is no bearish divergence in the MACD, which would suggest any pullback in GDX or gold miners is going to be met by buying rather than selling. Oil, we're stuck. You can see here the 50 EMA holds it up, but as I keep telling my members, there's the 50 EMA. Unless we broach that and then broach the 2017 low, you know, right at 50.71, I think we're going to stay in this overall wider range here, just like that. And this pattern right there in a MACD is nothing more than a consolidation pattern. The odds do favor a break on the chart to the upside, but if we break down here and break down like that, you can see the upward vector on the 200 EMA is pointing like that. It'll slowly start to level off as we go forward in time, and we can expect that to provide support. Okay, I don't see a lot of upside in oil, even with the production cut with OPEC, because we're also adding more rig count with the shale and the frackers here in the U.S. It's changed the entire dynamic of what, you know, OPEC used to just, they didn't even need to cut production. They'd just have a meeting and say, we're looking at cutting production, and oil would be $3, $4, $5 a barrel higher, you know, looking forward a month. Now they don't have the control that they had before, and I know it pisses them off, but that's the new reality in the oil market right now. And of course, we're trading this to our advantage. Gasoline. You can see gas tried to break this regression channel to the upside. Could not do it. We're back down in this area. Now, we are in a normally seasonal bullish mode for gas, but unless we can break this and take out, you know, some of these prior key pivot highs, then we're just going to slide lower. And that's not going to be bullish for gasoline. It's going to be, I think what we're going to do in gas for at least another month is we're going to be in one of these kind of crazy modes like this, where we're in this wider chop area, okay, which would make trading UGA, which tracks the gasoline product, if you can't trade gasoline futures, which is a very rich contract, UGA is the way to go. We'll be looking at with our members here this sometime in Q1 of this year. We just closed down another successful trade in agriculture with corn. We'll be looking at another setup shortly. Meats we haven't been in recently, and then one thing I hear people talking about a lot is cocoa. You can see right here, folks, this is just a counter trend move. I don't believe it's a reversal of this long down move in cocoa just yet. You can see here, cocoa, when it makes bottoms, they're very ugly. Let me just show you right here. You can see, and this is a daily chart, but this goes all the way back to 2012. You can see here on this daily chart what cocoa does. It'll get down in this level, and it'll come up, and it'll come back down, test that level, and then we had a couple of tests here. We even made a higher pivot high here from this one, and you would expect this pivot high here to come up like that, but it didn't do that move. It came right back down and tested this level. We almost tested it again before we changed directions and really took off. All right, we're just on a minor move right here like that, and I could see it going a little bit higher. I can see another retest down here, 1 or 2, before we move higher. If we look at this daily chart, right here like this. Ideally, what I would like to see, this right here is not a good MACD pattern to trade off of. I'd like to see a move up here to the 50 EMA, a roll back down, maybe even a lower low that would put the MACD like this, and then it would come down like that, and then a move up there, giving us a bullish divergence here, which would probably mean we'd come back up and test that high again. I would like to see that. Now, does that mean we're going to shoot up like that and keep going? I doubt it, given the way Coco traded before. I would expect some more ugliness down here before we finally release and get some escape velocity and start getting up in these levels again. But I'll tell you guys, we're going to be on this thing when it does do this, because we did the same thing in OJ, but only to the downside, made some good money. I don't think we're there yet with Coco. We'll watch it and we'll see. All right, everybody, that's kind of where we are for this weekend. For our members, I will see you Sunday night. If you're not a member, I highly encourage you to come in and either join our user group and our secret trader, or just our secret trader alone, where you get access to my trades. Either way, we're doing good. We did good last year, and we're off to a great start this year. You guys have a great weekend, and I will see our members tomorrow night. Have a good one, everybody. Ciao.